Hi traders, today we'll break down one of the most powerful ideas in trading, order blocks. These are the zones where big money enters the market. If you learn to spot them, you can understand where a move will start and where it will end. When you look at a chart, it may seem as if the price moves chaotically, up, down, with no logic at all. But if you look closer, it becomes clear. Behind these movements are not random trader clicks, but massive flows of capital. This is what traders call smart money, and one of the most powerful footprints these players leave behind is the order block. So what is an order block? It's an area on the chart where major players entered the market with large volumes. When a bank or a fund opens a position, it doesn't buy a couple of bitcoins or shares, it moves the price with an entire impulse. That's why after a strong move up or down, a print remains on the chart, the zone where the move began. That spot is what we call an order block. There are two types of such impulses. The first is bullish, formed when big players are buying massively. The second is bearish, when they are actively selling. When you see where a strong impulse originated, you understand where the big money acted. And that means you can assume that when the price returns to this zone, it will react again, because unfilled orders or interest from major players remain there. If the price returns to an order block area, it often bounces off it and continues in the direction of the trend. That's why many professionals use these zones to enter trades with minimal risk. It's important to understand that order blocks are not the same as support and resistance. Yes, both look like important zones on a chart, but the difference between them is fundamental. Support or resistance forms when price bounces off the same level multiple times. An order block appears only once. At the moment, large volumes enter the market. The price reacts, and that's it. Afterwards, it's no longer relevant. Many see a strong price movement and immediately draw a zone, thinking, here it is, an order block. But not everything that looks like an impulse actually is one. For an order block to be truly meaningful, it must meet three rules. The first rule, there must be a gap or inefficiency. When big money enters the market, the price doesn't move smoothly. It explodes. On the chart, it looks like a small empty space between candles. A gap traders call imbalance. To find an order block, you need to mark the first candle before this gap, from its lower wick to its upper one. That candle shows where the strong move started. The second rule, the block must remain untouched. In order, block stays valid as long as the price has not returned to it. If the price touches this zone even once, the orders inside have already been filled. Such an area no longer gives a reliable signal. The third rule, there must be a break of structure. If an order block is the footprint of big players, then it must be followed by a change in market structure. The market moves not in a straight line, but in waves. In an uptrend, price forms higher highs and higher lows, each top higher than the previous one, and each bottom higher as well. In a downtrend, it's the opposite. Highs and lows become lower. When price breaks a previous high, that's a break of structure. And when it violates the previous pattern, for example, switching from an uptrend to a downtrend, that's a change of character. And only if one of these signs occurs after the order block, a break of structure, or a change of character, you can say, yes, this is a real, valid order block. And remember, if you want to get the most out of such trades, HashHedge can help you, a prop trading company that allows you to trade with company funds instead of your own. 4% per month from $1,000, that's $40. 4% per month from $100,000, that's $4,000. You don't need higher returns, you need more capital. You pass a simple evaluation, show your discipline, and get access to an account from $5,000 to $100,000 plus. Earn more, risk less, together with HashHedge. Now that we know how to find real order blocks, it's time to understand how to use them. I'll show you 3 proven strategies that help catch moves with a high probability of success. The first thing to pay attention to is confirmation on different time frames. Start with a larger scale. For example, the 4-hour chart. Find a strong move with a gap and a break of structure. That will be your higher time frame order block. Let's say you see a bearish block on the 4-hour chart. Now move lower, say to the 15-minute time frame, and wait for the price to return to that block's zone. As soon as it touches the area, you look for confirmation, a reversal pattern, a break of local structure, or a simple candlestick pattern like a bearish engulfing. If everything aligns, you enter. Place your stop loss slightly above the block and your take profit about twice as large as the stop. This technique gives a clear filter. The higher time frame shows the direction, the lower one shows the entry point. The second point, the inducement trap. This idea works against crowd psychology. Imagine a small support zone forms, several consecutive bounces, everyone sees it. Everyone believes price will bounce again, but below, it hides the real order block where big players are preparing to enter. The crowd buys at support, and price suddenly breaks it, triggers their stops, and only then reverses upward from the order block zone. That's why this is called an inducement trap, a trap for those trading obvious levels. The right move: place a pending order right in the middle of the order block and simply wait. If price doesn't reach it, no problem, you just skip the trade. If it does, the entry will be nearly perfect at the lowest possible price, while everyone else exits with a loss. And the final strategy today: breaker blocks, the power of a broken level. Remember how I said order blocks are one-time zones? Well, there's an exception. When the price breaks an order block, that same area can turn into a new resistance level. This scenario is called a breaker block. For example, the chart had a bullish order block, price moved away from it, but then broke down through it. What does that mean? The market changed direction, the trend became bearish. Now that same block works the opposite way. Instead of support, resistance. And when price returns to it from above, you can look for a short entry. This is one of the most reliable trend reversal signals because it shows smart money switch sides. Order blocks are not just zones on a chart. They are the footprints of real actions taken by major players. If you learn to read them, you stop guessing and start understanding why the market moves the way it does. Over time, you'll start seeing these patterns effortlessly, and the market will become as predictable as a book written by big capital. If this video was helpful, like and subscribe. See you in the next one.